Closed captioning of this program is brought to you in part by AGF. What are you doing after work?
Let's talk to Joe. He's in Barrie, Ontario. Hi, Joe.
Hi, guys. Great show. Thanks for all the information.
Thanks.
I got a question about Kinross. I'm looking at it for a potential entry point. I know I shouldn't be bottom fishing, according to what David is suggesting here. I agree with that somewhat. But margins for mid-sized gold producers, would you say Kinross has got some legs 2-3 years out?
Right.
I'll hang up and listen to your call.
So Joe, certainly I can't tell you that they won't. Our preference is if you're going to own a gold equity, we prefer the royalty companies and the streamers as a first entry point. So I would prefer something like a Franco-Nevada, which has less risk. Kinross has had their fair share of troubles over time and has not been one of the leading companies in the group. So there's others probably that you'd maybe give you better advice on this one because it's not been one of our favorites. I would suggest in the kind of market that we're in, if you're going to own a gold company, own one of the royalty companies, which I think gives you exposure without so much risk to price.
Right, and you mentioned you've been trimming your gold positions a little bit, Sandstorm, Franco-Nevada, presumably.
Yeah.
What's your long-term outlook for gold? You are, remember, somewhat bullish, are you?
Yeah, I think that as we go along here, central bankers are going to continue to try and inject monetary stimulus to the system. They've gone this far. They're going to go whole hog, I think. So I think that as they continue to ultimately print money, you're going to continue to see gold perform probably pretty well against paper currencies. So I think that is true. But given that gold equities are a favorite of hedge funds, and given that we are into a correction here that could have some legs to it, I think you want to be cautious. So gold, I can see owning, and we do own some gold units. But we are somewhat more cautious on the producers now.
Okay, David, here's Sunita in Stouffville, Ontario. Hi there.
Hi, good evening, gentlemen, for taking my call. David, my question is on Microsoft. I bought some when it was trading around $29, hoping that when Windows 8 comes out, it'll boost the price. But however, that doesn't seem to be the case. My question now is whether I should, it's worth holding on to it, or should I sell it and take the loss? Number two, is there any way you could suggest any other in the tech industry other than Google and Apple? Okay, I'll hang up and listen to you.
Okay, thanks, Sunita.
Sure. So, Sunita, my suggestion on the Microsoft probably is to move to the sidelines. I don't think that there's tremendous risk in it, in that it is a really solid company, really great balance sheet, tons of cash. The problem is PC is really under fire right now. So, unless they can really demonstrate that they're getting turned around, and as you know, earnings decrease and revenue decrease in the most recent quarter, not that positive.
Yeah, I just saw today Windows sales, or I was reminded today, Windows sales were down 33% year over year.
Right.
So that really, and that goes to what you've been talking about, the decline of the PC. And Bloomberg got a story today about the death of the PC, basically.
Right, and that's not an impossibility. If I were going to choose something in technology, and seasonally November, December tends to be a stronger period for tech, it doesn't appear to be playing out right now, I would want to own one with a secular theme in place, a real tailwind. So I would look at something like ARM Holdings, and ARM Holdings are low power, chips that consume very little power and that are in mobile devices. They're being considered right now, I think, by Apple for a number of their newer devices, and get royalty streams off of the use of their technology. I think that's one I'd take a look at. I'd take a look at Qualcomm, which is a big beneficiary of the growth in mobile data traffic. Those are the two, I think, that probably make the most sense.
And would you chase it up around these levels?
Well, if that was a longer-term chart, it would show that it's really consolidated over the course of this past, 12 or 14 months, and has recently broken out. So would I love to buy it as it pulled back into that consolidation? Absolutely. But I think you could initiate a position here and look to add to it if it pulled back into support around, I guess it's about $28, $29.
And you've held this in the past?
Yes, absolutely. Yeah, we don't own it currently.
Right.
because we're just a little cautious on tech, but it's certainly on my farm team and one I'd like to own if the group could start to get swung around.
All right, you might bring it up from AAA. Here's Carol, who's in Calgary. Go ahead, Carol.
Hello, and thank you for taking my call.
You're welcome.
My call deals with Crescent Point Energy. There's been a significant pullback in the price of the stock, and I would like your comments on what would be a good entry point as a buy, and where do you see this stock going in the next 6 months, perhaps up to a year? Thanks. I'll hang up and listen to your
thanks,
response.
Carol.
Carol, this is a sore point for us because we've recently been stopped out of this one.
Oh.
We bought a little bit of Crescent Point in the late summer and quickly have been stopped out of it. I think that the problem is you're facing difficulty across the whole energy producer space. In full disclosure, we're short the XOP, which is the producer's index in our ETF portfolio, and we have very little producer exposure at this point. Crescent Point, I think, is a great company. I think that they've got all kinds of opportunity to grow their production, lots of targets, great properties. Operationally, they're getting much better. They're just fighting a very difficult market tape and sector tape, and so in the short run, probably there's some risk there.
And how long have you been short this one, the XOP?
About 6-8 weeks.
6 to 8 weeks.
Specifically, partly because within that, there are a lot of the big gas producers in the U.S., like Chesapeake and Devon Energy and so on, and they really are having a tough time.
Yeah, and it seems to be working so far. Let's talk to Devinder in Walkerton, Ontario. We'll get back to technology now. Hi, Devinder.
Hi. I want to ask about Apple. It's generating a lot of cash, but for last few weeks it is getting crushed. What's your outlook on Apple on short term and long term? I will hang up and listen to you. Thanks.
Well, Devinder, I'm not going to be popular this evening. I have to disclose we're short Apple shares in some portfolios. And I use the devices. I've got one sitting here on the desk. I realized, though, a little while ago that we had 3 iPads and about 6 iPods and a couple of iPhones in our house, and we probably couldn't buy any more. The issue here, I think, is that every portfolio manager for big portfolios owns a stock, or the majority.
About 800.
And because it's been performing poorly, because there is concern about some of the changes in taxes, because there has been some concern around the level of innovation coming out in the last couple of devices, an iPad that's smaller and an iPhone that's bigger, more or less, that there isn't the same kind of innovation taking place. And it's a very widely held stock. When a widely held stock, which has been a leader all the way through the cycle, starts to break down, it can take a long time for the over-ownership to be washed out. I'm not saying there isn't good value. I'm not saying it's not a great company. But from a timeliness standpoint, you have to be more of a value investor to be stepping into this market to buy this stock right now, and you have to be prepared to see some volatility. Going back to the lows of 2009 to the peak, the stock was up about 750%. Do you think that it wasn't a blow-off top, but do you think that may have been it in terms of a peak for Apple? I think that there is very real risk of it. And somebody showed me a chart a couple of weeks ago that was a little bit scary. It compared the chart of Apple to the chart of RCA in the 1920s.
Saw that, yeah.
And, in the 1920s, RCA put a radio in every house. And not that they went out of business. They were in business for a long, long time. It's just it wound up being a wildly over-owned stock, and it took years for that to be washed out in favor of other securities. So I think you want to be a little bit careful. You want to watch it. Certainly it's a great company. Earnings growth has been good. Revenue growth has been good. But they've had a couple of little missteps recently, and we have to watch how this behaves.
And last question on Apple. Where do you cover your short?
I have to tell you, I don't know. We have a stop loss on it, and we'll see where it goes from here.
Okay, David. A short break here once again with David Burrows. More insight from him on North American large caps and other types of strategy right after this.
We've been taking the Cadillac